filtering in. Okay, my name is Andrew Jeffries. I'm the session chair for this morning's session number 17 on new models for investing in energy efficiency projects and businesses. I'm the director of the Southeast Asia Energy Division of the Asian Development Bank. And I have 5 distinguished speakers from various backgrounds and work experiences here to share their presentations. So I guess we'll get right into it. I'll introduce just one at a time. Speakers are going to be presenting for approximately 10 minutes. We'll go through all 5 presentations and then we'll open the floor to questions and answers for the rest of the period. So I guess our first speaker, Mr. Ingo Poole. His career in clean energy as a consultant to the World Bank started in 1995, became a pioneer in the emerging international carbon market. After relocating to Bangkok in 2005, he led South Pole's efforts to develop a carbon finance-backed clean energy project portfolio in Asia, consisting currently of around 150 projects. In his current capacity, he works with many countries on their efforts to establish results-based policy instruments for incentivizing clean energy investments and on the design of clean energy finance vehicles for institutional investors. He's also a business angel investor in Asia's growing social enterprise sector. So let me introduce Mr. Ingo Poole. Thank you.
Thank you, and good morning, everyone, and thanks for getting up early. Presentation is I'm going to introduce a project we've just completed with some partners in Vietnam. Basically, the way we work these days is, we start with working with governments. Everything is now driven by which is different from what we did in Kyoto. Developing countries making now their own contributions, right? And from these kind of policies, sector policies, first, basically national policies. From these national policies, it breaks down in sector policies, and then on the sector level, we have to understand, within the sector, what are the things that we can usefully do, what kind of incentives are required to make sure that that there are then investments, actually, again, on the action level, sector policies uses if it doesn't stimulate action on the ground, and then to translate it into action, and then the actions translate into emission reduction that then contribute to these NDCs, nationally determined contributions, right? Of course, right now we have INDCs, intended national determined contributions. I have now just given you here the big picture. I want to really start this top-down presentation on the energy savings guarantee scheme. I'll get to that. So basically, we have a business as usual, right, for the country as a whole. And then we have what's called the unconditional contribution, which is what Vietnam wants to do on its own. And then we have the conditional contribution, which is additional actions that the country can implement with international support. Next slide, please. Okay. So basically, this is now on the sector level. We're looking at the cement industry in Vietnam. We have a current cement production, right? A certain carbon intensity, which is basically constant for the baseline, and then total carbon footprint, simple multiplication. Next slide, please. So what we have now done is we went into the cement sector and did this marginal abatement cost curve. I think also everybody knows what that is, right? And we have identified a set of over 30 actions, that could be done to mitigate CO2. And what you find here, there is a very substantial potential for negative cost actions. Negative cost action means actually other things that the industry can do and actually save money. amounting to a substantial, thank you, amounting to a substantial quantity and cost. This is just a breakdown. I'm not expecting you to read the details of that. It's going to be in the presentation if you really want to take a closer look. Next slide, please. And then if we now just look at those actions that are commercially interesting, where the industry can actually save money, we see that we can drive down, all these are all the mitigation actions with negative abatement costs, right? We can reduce the carbon intensity from 0.74 tons per ton of cement to 0.58 by 2030, which is basically the target year, right? Reduce CO2, you see that, of course, absolutely speaking, CO2 first goes up, but then once energy efficiency really becomes big, there's even an absolute reduction already of CO2, but relatively speaking, we get to a minus 21% energy efficiency improvement in the industry. Now, and again, in the first slide, you saw that Vietnam's target was to reduce the carbon intensity of cement production by 20%, right? So what we found is that just focusing on those projects at negative cost, actually Vietnam can, in fact, achieve its unconditional contribution on the INDC side. So that's very good news, right? The next slide, please. But as always, the question is, why don't these things happen already in energy efficiency, negative abatement costs? Because there are barriers, right? And so what we've done is we've done an analysis of these barriers, and this is basically the story, right? There's a problem, with understanding and believing in the value of the energy cost savings, right? It's the lenders and the financiers who have no experience with that, right? The facility owners, they're also not willing to make the leap, right? They're also not really sure with this, right? And the ESCOs, the technology companies that are the ones who actually believe in the energy cost saving, they usually lack access to the finance to make these things happen, right? So, next slide, please. What we have kind of like found or created, and actually also copied, is an instrument that was developed by the Climate Finance Lab, which is a collaboration between, let's say, climate finance actors from the public and from the private space, right? To create an instrument that would allocate the risk associated with the uncertainty of the cash flows using a guarantee instrument, right? So maybe this is the one slide that I want to spend a little bit more time on, right? The way this works is, at the end of the day, we have an ESCO that takes out, that gets a guarantee that guarantees the cash flow of the intervention to the lenders, right? And this is supported, basically, it's a commercial transaction, but in the beginning, to get this going, it's very important that there are, let's say, climate finance supporters who are willing to take that risk in order to make mitigation actions happen, right? The trick here, of course, is going to be, at what level can energy savings be guaranteed? At what levels of confidence, right, do these savings happening? And then, of course, the result of that risk is what is the price for the insurance premium, right? And that's where in the details, I think we need to do a lot of work still, right? We have some experience with this because we operate a similar clean tech performance guarantee mechanism for the Swiss government for basically innovative climate low carbon technologies, right? And we also benefit doing this. We benefit from the experience that we have from having looked at close to 2,000 projects when we were just a carbon credit company, because for carbon credit origination, understanding performance risks in detail is actually basically, that's what you need to do all the time, right? So we can deploy that knowledge to help, our partners price the risk price the risk right. This is still a concept, like so we're just working on implementation going forward. Just to give you, next slide please, that's already my last slide. Just to give you an idea of the overall size of this, right? Like those mitigation actions that lead to a 21% reduction of improvement of energy efficiency in the cement industry require an investment of about $1 billion. So it's a sizable investment opportunity, right? Basically over the time, it's basically $70 million per year. We need to get experience with this, right? So for the first 3 years, we think that the cost of the guarantee mechanism amounts to about 5 to 8% of the capex investment. But like just to give you ballparks, right? And then once we have experience and data comes back, we think we can drop that cost to about 2 to 3% of the required capex. So it's very doable, right? So if you look at the cost, basically in the beginning we think that we basically need to guarantee 100% of the investment, right? So that's in the beginning. This facility would have a size of around $210 million. Again, not big numbers to do something very interesting. And then over time, we think that actually that can drop to some amount. Okay, that was already my presentation. Thank you very much. I think we agreed to do question and answers at the end of the session. Yes, thank you.
Okay, thank you very much. Okay, so the next speaker is Mr. Norman Michaud. He's currently the director of the international group of Econoler. Over the past years, he's been active as an expert in the field of energy efficiency and has worked on a wide variety of subjects. Mr. Michaud has designed and implemented many energy performance, contract, and demand-side management projects. Furthermore, he's developed an expertise in the preparation of national policies, such as energy service companies' support schemes and standards and labeling, both in industrialized and developed countries. International undertakings have brought him to all regions of the world for ventures led or financed by international institutions. Thank you.
Thank you. Hi everyone, pleasure to be here. So I'm here today to talk about the super ESCO concept, not just talk about the conceptual approach to it, but also to present a concrete example of super ESCO that was implemented in 2013 and has been running for the last 3 years. So I'm thinking that most of us here understand the ESCO approach. Others will talk also about the ESCO approach, but definitely the ESCO approach, as you most know, is based on the energy contract performance approach. The investment is based and the payment are based on the savings that are either guaranteed or shares afterwards. There are a lot of barriers to the ESCO approach. We've been working on ESCO for the last 35 years here at Commodore, but in the market also, most of us have been facing with the ESCO approach and the barriers that we have observed in different countries, different markets of the world. To help the ESCO market grow, a couple of years ago, the concept of implementing what we call a super ESCO came up. The concept basically was designed as a way to implement, to accelerate the growth of ESCO in the market and providing them a bigger market that can reach out and allow them to implement more projects with more actors. The definition of a super ESCO is it's an entity which is established by a government entity to initiate and/or support capacity building in the activities of other ESCOs and to facilitate the access to project financing. So a super ESCO normally is not acting as an ESCO itself. What it's doing is it's facilitating the access of project to ESCOs that are already in the market. This conceptual approach came up as a way to address many barriers that were in the market and that we have been addressing in other ways also. But we thought that approaching it with a super ESCO approach would be able will allow us to address many of those barriers together and brought a huge growth in the local market. The barriers that are normally addressed by it is the lack of access to public sector facilities. So in many markets, be it because of procurement rules, regulation, local ESCOs or private ESCOs sometimes are either not big enough or can access public building project. As I said, either because the public building cannot use the approach, or because it's just too difficult for them to reach out to those kind of customers. It also has been developed as a way to access to address the limited access to tailored project financing. So financing of ESCO projects has always been an issue. We've been working with banks, we've been working with putting in place a guarantee fund, a revolving fund that would help the ESCO market in a market. In a way, the ESCO are often limited in terms of financing because they get financed on their own company, not on their projects. So we've been pushing project financing for a while. It's working in some countries, but not everywhere. The Super ESCO was a way to bring this financing and allow those at local ESCO to do more projects under the same period of time. Also, we often seen high transaction costs for smaller projects, so the Super ESCO is normally a way to bundle up projects together as a way to reduce the transaction costs and make them more viable. So we can have a look here at again, it's the models, conceptual models. There are also, of course, some flexibility in it, but normally the way it was set up is that Super ESCO comes in, work with the private sector over there. So you have to have already private ESCOs in the market. So they work with them on the project. They work with the government. Normally it's set up by government. It can get financing by the government. It can try to get financing from the private sectors also. Then they reach out to the public building, public sectors, and even industrial sectors. There's no limit there, but of course it's easier for them to reach out to the public sectors. It's often, so normally they would be set up by the government. So they reach out, find out the project, explain the approach, guarantee the savings, and then they go on in the market. The owners of the buildings and the facilities or whatever agree with it. Then they go on in the market, do procurement with local ESCOs, and work with them on implementing the projects. All of that has been designed and developed over the last couple of years, but we haven't seen that many examples of real ESCOs, Super ESCOs in the market as of now. Econar has been working with the ETIHAD ESCO since 2013, which is, again, one of the first real Super ESCO I would say in the world. It was established in 2013 as an initiative by the Dubai Electricity and Water Authority to create a viable market in Dubai for building retrofit using the ESCO approach. So, as you can see, their goal for 2030 are pretty ambitious. They expect to save, to have annual savings of 1.7 terawatt hour by 2013. Also by 2013, they are expecting to save annually 5.6 billion gallons of water and 1 million tons of CO2. Those savings together from their estimate will bring up annual savings, monetary savings of $270 million. So since its inception, so the mandate that was given to ETIHAD ESCO in this case is, as I said, to create a market for an ESCO company using the energy performance contracting approach, of course. They are putting the initial focus on government buildings, with leading by example. So there's already some local ESCO working in the private sector. What they want to do now is push them and train them and have them work in the public sector and show the market what can be done in terms of savings and how it can be done and prove, I guess, that the concept can work in the market. They also try to use the portfolio approach, so instead of the single building approach, they approach the project on a commercial basis, so it's not because they're getting financing from the government and that they are set up by government that they are there to lose money. We still need to provide and show that what they are doing is commercially viable, again, to prove to the market that those project, the ESCO project and the ESCO approach is interesting. And they also help arrange financing. The role that they have in projects, so we've seen the model, I showed you the conceptual model. It's a little bit different depending on what you want implemented, but in this case, they follow the model pretty closely. So they do pre-qualify buildings. So they have their own engineers going there, meeting with the building owners on the public sectors. They visit the building, they walk through it, they figure out if the building is interesting for energy performance contracting approach. They approve those buildings, They organize after that the tendering with the local ESCO. They select the best ESCO, not based on the cheapest, but based on the most savings for the investment offer. They also arrange financing, which they are getting from the Emirates Development Bank. They follow up on project execution, so they're there from start to the end. So they follow up with the ESCO on the implementation of the project. They also follow up after that on the guarantee of savings. So they do the measurement verification with them. They're the one providing the report to the owner and the customers. So just to show here, so as you can see, the model is pretty similar to what we saw as the conceptual model. So they are providing the guarantee of savings to the building owners. They are working with the ESCOs and the money. In some cases, they wanted to use the financing themselves, but in other cases, they also use the financing and go directly to the owner, depending on what the owner wants to do. Current situation. So as I said, it's been implemented in 2013. As of now, they have already completed 2 projects. So of course, simplified approach, and one of the most simple thing was to start working with Dubai Electricity and Water Authority. So they worked with them on 2 projects, one of $6 million investment to save 15 gigawatt hour of savings for 3.5 year payback, the other one on $4 million investment, 5 gigawatt hour of savings. Those projects are running, savings are demonstrated. It's been running for a year now. They are reporting on the savings to the UL. They are also currently implementing the retrofit of 150 staff accommodation buildings. This is in construction right now for a total investment of $17 million. They have 2 other projects right now that are in the awarding process, so they're waiting for procurement. And they have 6 upcoming projects in their pipeline. And the surprising thing is they were already able to reach out to the private sector. So out of those 6 projects, one of them is with one big industrial site, and the other one is they have been able to bundle 300 private sector buildings with different owners together to one big ESCO project. So maybe quickly lesson learned out of this. As I said, it's one of the first real super ESCO I would say in the world that we've been working on. We've tried to we've designed the concept and we've helped other market try to implement it, but it's not something that is that easy as some of you know. The government needs to be extremely willing to do so and go on and go forward. In Dubai, it was, I would say, easier. The government have been putting a lot of pressure and a lot of intent on becoming the champion of energy efficiency in the world, so that helped. As you can see, and as we saw with the ETIHAD ESCO, it gives a lot of credibility to a concept that is still not well known. Even if we've been, the concept has been there for 35 years, 40 years, it's still, many market, there are so many actors, right? Private sector, public buildings, a lot of them don't really know how they should know on the, they know the concept, maybe they know the name, but to know exactly what it means in terms of how do we do the procurement, what are the contracts, what do we need to be careful about in those contracts, how do we demand the afterwards, how do we define the baseline, and so on and so on. It's extremely difficult. So when you have someone like a super ESCO in there that is showing the credibility of the concept, and that are working with local ESCO, kind of shows that the DOS project works and they can go forward. It's a good approach to use. It's also addressed many barriers, as I said, as the acquisition costs. ETIHAD ESCO, as I said, was able to bundle many projects together, enable public sector to improve efficiency. So that's a way. It's a good way for them. And in this case, they're using the government development fund, but in other cases, it could be done with private sector funds. So bring more money to invest on the energy efficiency of the government buildings and go and implement those as soon as possible, as fast as they can. And also builds local ESCO capacity by requesting certification. So the ESCOs that I showed you, there are 15 ESCOs right now that are certified in Dubai to work with the ETIHAD ESCO. To do so, the regulatory board has been implementing a program on certification. So they make requirement on the size, of course, but they've also made a lot of requirement on the expertise of the experts within the ESCO, on they have to be certified CMVP. And when you want to improve the market in terms of capacity for the ESCO, use the certification. Over time, you can improve the requirement, you can increase them depending on what you see, how ETIHAD ESCO is working on a project. If they see that something is missing, that something needs to be built into the capacity, well, they work with the board on improving the certification and so on, and that local market grows and gets better and better. So, a bit too much, but sorry, but thank you for that.
Okay, so we've heard from about energy savings guarantee scheme using Vietnam as an example, and now we've just discussed what's going on in Dubai. So now we're going to focus on about halfway in between the two in Bangladesh. May I please to introduce Mr. Rakesh Kumar Goyal. He's a senior power sector specialist with over 30 years of experience. He is specialized in power sector reforms and clean energy. He began his career with the Uttar Pradesh State Electricity Board and has later worked with Tata Power and Siemens. Currently, he's the India country head of Tetra Tech. He was chief party of the USAID programs and led several clean energy projects sponsored by ADB and the World Bank on smart grids, renewable energy, and on energy efficiency. He's currently leading a project in Egypt for establishment of energy efficiency units. So he's a frequent speaker at national and international forums, and he was a team leader in an ADB-sponsored project for the energy audit of 120 industries in Bangladesh, and building capacity of financial institutions, banks, and for energy efficiency programs. So welcome, Mr. Goyal.
Thank you, Andrew, for a long and a kind introduction. And good morning, ladies and gentlemen. I am going to present the experience or the learning that we have by executing an energy efficiency project sponsored by Asian Development Bank in Bangladesh. So before that, few words about my company in which I work. So I work in Tetra Tech, which is a consultancy firm, provide consultancy in energy, environment, and water sector. About annual revenue of 2.6 billion, Nasdaq listed, employee 16,000, global offices more than 400, and I represent their India office. Before we go on the learnings, let's know the projects a little bit in shortly. So in this project, we have to do the energy audit of the 120 companies in the 6 highly energy intensive sectors, which were their textile, ceramics, iron and steel, cement, chemical and agro. And then we have to conduct 3 workshops to build the capacity of the financial institutions and the banks there. Output basis, the project started in December 2012 and completed in May 2014. In fact, it got completed in December 2013 as anticipated in 1 year, but there was a 4 or 5 months lull period in the project because of the geopolitical situation in Bangladesh, elections, etc. were going on. So the investment grade audit was conducted for 120 industries. The reports were prepared and given to the industries. 3 capacity building workshops were conducted where 40 institutions, 40 different banks and the financial institutions got involved. And we did a final conference in which more than 300 delegates participated, along with the manufacturers showcased their kiosk showing their energy efficiency equipments. Financial institutions put their kiosk so that if the industry people want to have a contract negotiation or financing, that can be facilitated. And we developed some about 13 financial tools which may help financial institutions in quickly converting kWh and cubic meter gas into the Bangladesh taka. The project, as I said, was under a grant scheme from the Asian Development Bank, and about 30 members worked in the project, 9 international consultants, 13 national consultants, and the other support staff. Let us look at the results directly without going into much details. So here are the results for the 120 industries that were audited in different 6 sectors. So I will draw your attention to the last line, which is the total rather than going on a sector basis in view of the time. So 120 industries, if we make an investment of the 140 million USD, the annual saving is around 45 million, and energy saving is around 30%, with an average payback of 3 years, and an project IRR of 25%, and with a carbon dioxide reductions of 170k tons annually. So these were the results. I don't know on that basis or otherwise. Recently, Bangladesh has committed after this COP21 a 10% industrial energy reduction. Now let's look at that on the finance part, that how many industries have took the finance and moved ahead of it on the basis of these reports which they got. So this is the data that has been collected on the basis of the industries they themselves informed us. Or as I told you that there was a 5 months gap, so when they meet us in the final conference, they shared with us that they are going on. It is not based on very authentic survey, so it is just possible that there may be more companies, but which are not getting reflected here. But nevertheless, it's good to analyze it that about the 22 industries out of 120 decided to implement the suggestions, and out of these 6 decided to go with their own funding, and 16 were looking for the active financing from the bank. And under this PA, about 2 have been signed and they have been awarded while the contract was going on. And on the basis of 22, the impact is in 34k tons of carbon dioxide reduction, which is sure, and there may be many more which have not reported us. Now on that basis, then what was the key learning? Why out of 120, 100 have not gone for this implementation if the project IRR was more than 20%, payback was 3 years, such a data. So this question occurs to us, and we thought of let's analyze what could have been done better. So I'll share with you now in the next few slides what was our learning. And please remember that those learnings are based on the Bangladesh project, so they may not exactly be true for other geographies also, but definitely they can be tuned to the local requirements and they can be utilized. So we have seen that there are 4 key stakeholders in the whole game. One is the industry itself, other is the financial institutions, then the government and the manufacturers. And all have to do a bit in order to keep the things moving and both the financing and the implementation of the energy efficiency projects to take place. Let us look them one by one, what they need to do based on our experience of Bangladesh. Again, what I am going to present here is limited to Bangladesh. Please, I once again emphasize, and if you want to use them for other geographies, you need to tune them on the local basis. On the industry side, there was a limited knowledge. We came across companies who says, what do you mean by energy efficiency? What does energy efficiency mean to us? So from that term was new to them, and we need to explain that. So that was the situation of the awareness. Want to talk of about some of the equipments, energy efficient equipments which they can use, variable frequency drives, or the 3-pass boilers, or other things. Then seeing is believing. What we have done is some industry or some of their fellow industries had adopted some technology. It has a very fast cascading effects on that. So it is useful while we do the facilitate the energy audits, we should also do some of the implementation part also, 2-3 projects gets implemented. So which will have a much better impact. The third part is that when the question of financing comes, the industry feels, and that's again for the Bangladesh case, that it means a lot of paperwork and a lot of rounds of visiting the banks. So there need to be done some improvement there. Banks need to standardize that these are the documents, online submission of the application, time bound results and processing of the applications. So that fear can go. So most of the industries prefer either managing their own funds or taking loan or something, continuing with the existing bank rather than try something new. From the financial institutions and bank perspective, we feel the banks need to look at as a new product line, energy efficiency as a big market and a new product line. But that feeling is not there. And they still feel it is like a normal financing thing, it can be done in a normal channel, which really doesn't work. So we have experienced in some of the other countries where the banks or financial institutions have created a special technical cell to to deal and appraise those applications where the things have moved much faster. And they are going the money on some interest rate, so they are making money. So it's a new product for them, and it's a lot of business opportunities. But then marketing is completely missing, and we still felt in Bangladesh it's an approach which is like giving money to somebody industry, so they are obliging, so the taker has to come to them several times and fill all those papers. Then also we have seen that new financing methods need to be developed. There were several companies, and it happens in energy efficiency financing, they are in red. So when the last 3-year balance sheet is not good, straightway the financial institution reject their applications. Now, without realizing the fact that by implementing the energy efficiency, they can come back. So maybe something like online bill financing or some other methods need to become out, new financing methods. The old conventional way of looking that if the balance sheet is good, we will give the financing when really not work. Then coming from the government side of it, we find some of the policies the government need to do. We have seen cogeneration plants. They have the turbine of higher capacity, they have the steam, but they are doing PRDAs. And they are running their turbine on 60% load, losing further efficiency. Because there is no adequate policy to supply the surplus power to the grid. Either there are technical reasons are no more exist. It's only a question of facilitation and a good policy, which is missing. Similarly, when the industry puts, most of the industry in Bangladesh uses their own gas generators and generate electricity. That's a separate story why it's such an inefficient situation exists. But then what happens when they have the production capacity 60%, 70%, the generator load is also 60, 70%, which is again reduces the efficiency. Because they can run it 100% if there is a good policy for in terms of supplying the surplus power to the grid. Then they need to come out and standardize some of the things which is very distinctly visible. Most of the leather industries were using single pass boilers. This is highly inefficient. So the government can standardize such projects, replace boiler, this is the payback, this is the finance, and so everybody can have a faith and can adopt on that. Then something on the manufacturer side, I found manufacturers are very, very passive. The most beneficial, they are with all due respect to the manufacturers in this whole project. Hardly I have seen any marketing from their side of their own product which are existing. With the gas generators and some of the exhibition I said, what is the efficiency you can claim? They say 88%, 85%, 87%. I said, show me a case in Bangladesh where you are achieving that. There was none. Mostly they were running on 30%, 35%, 40%. And they need to come upfront. Performance guarantee they should do, help the financial institution to finance and share some of the risk. So this was the last slide. So again, those are some of the learnings. I can say those are some of the tips when the energy efficiency financing or the projects need to be implemented. But please tune them based on the geography in which you are working. Thank you very much.
Okay, thank you. Okay, so next we're going to hear from Craig Morgan. He has over 18 years experience in assisting organizations to reduce energy costs, adopt renewable energy, and reduce CO2 emissions. His experience includes both technical and strategic advice to end users and to utilities on demand-side response, demand-side management programs. He's the founder of several consulting firms, and Watley is now the largest aggregator of energy efficiency certificates under the Victorian Energy Efficiency Target in Australia. So welcome, Craig. Thank you.
Thanks very much. And look, this week's been a very significant week for us, actually. 2 days ago, I was sitting in the audience listening to one of the presentations, and I received an email from my colleagues in Melbourne that told us that we just created our 1 millionth energy efficiency certificate in Australia. So what's interesting about that is we started in 2012, and in January of this year we created 500,000 certificates, and then in the last 5 months we've doubled that number. So that just gives you a bit of a sense of what sort of experience we've had as just one certificate provider in the energy efficiency schemes in Australia. So today I just want to talk a little bit about the schemes, how they work, what projects have been incentivised under this particular framework, and it's interesting seeing in this forum all the different frameworks: super ESCOs, government-driven subsidies, government-driven giveaways for LEDs in India, and sort of I guess other models. This particular model that we're talking about today is a government-regulated model that encourages private sector participation and creates a market, a floating price and a market for energy efficiency certificates. So I guess I just want to sort of talk about that to perhaps help people think about what elements of that program might be applicable elsewhere in the world, and particularly in Southeast Asia, whether that's program design, product information, tools, methodologies, or even business models. Okay. Okay, so the big picture is that the objective of the government's actually what I was going to do was just explain to you where we're talking about here. So New South Wales and Victoria have an energy efficiency scheme. New South Wales and Victoria have the largest populations of the Australian states, about 7 million people in New South Wales and about 5.5 million people in Victoria. The government's wanted to create a market to achieve greenhouse gas abatement through incentivising energy efficiency. How they were intending, or how they wanted to do that, was to regulate and set targets for the number of certificates that were to be created every year. The policies are now put in place that those targets will exist out to 2025 and 2029 in Victoria. The New South Wales target is 2.3 million certificates, and the Victorian one 5.4 million certificates every year. The liability to purchase those certificates is placed on the energy retailers. So in Australia, it's a deregulated energy market, and the energy retailers are the people who trade electricity and buy electricity off the wholesale market and sell it to consumers. One certificate is 1 tonne of CO2, which roughly equates to a megawatt hour of energy savings, but it's slightly different in each of the states because of the state-based electricity emission factors. Energy retailers buy certificates from an open market. The costs for buying those certificates that the retailers incur are then recovered from energy bills from consumers. And there are penalties for non-compliance. So the penalty rate effectively sets a cap on the certificate price. If the certificate price went above the penalty rate, the retailer wouldn't buy a certificate, they'd pay a penalty instead. And that penalty rate is, I think, in the order of $40 to $50 per certificate, something around that mark. The government regulates or sets and establishes approved methods to create certificates, and there's quite a lot of deemed methods. So forward creation, 10 years worth of energy savings. You can create certificates from the forward 10 years worth of savings and create those today and claim the benefit of that today. And that's really important in why I think they've been quite successful. And that's because it brings back, it simplifies the transaction cost, reduces the transaction cost, simplifies the approach, and brings back that benefit to the purchase decision today. There's also a range of measured savings. So that's around large industrial facilities and more complex commercial energy saving projects. There are only a number of approved private sector actors to create certificates after projects are completed. So the end users don't create them, only accredited certificate providers. And the price for certificates floats based on supply and demand. We'll have a bit of a look at one of the trends later on today. So this is my complex diagram of the session. Hopefully with that sort of background, I can now explain to you what happens here. So in the blue box here, you have an energy consumer, a building, a facility, it could be even a household, doing an energy efficiency project. That customer assigns the right to create certificates for those energy savings to the accredited certificate provider, which is the orange box there. And the accredited certificate provider pays the consumer for the certificates discounted off the wholesale price, because the ACP has to make its money. The ACP helps the consumer complete all the paperwork, deal with all the government compliance requirements on their behalf, things like keeping records for 6 years, taking photos of the installations, taking photos of the labels of the lights, for example, drawing floor plans to validate that the project is real and that it's actually being implemented. The ACP aggregates and submits those certificates for creation in a government registry. So the certificates are pending registration, and then the government looks through and makes sure all the compliance documents are in place and the certificates are fully registered. Once they're fully registered, they can be sold on the open market. And so the other thing, a household level LED upgrade might be, I don't know, 10, 20, 30 certificates. It's worth maybe $100, a few $100. The utilities don't want to buy a few $100 worth of certificates, they only want to buy $100,000 worth of certificates. So the ACP's role is to aggregate up all these certificate creations. Once they're fully registered in strips of 5,000, they'll sell those to the utilities. The utility pays the ACP for the full price of the certificates and then transferred to the utilities account. And then the utility has to, at the end of each year, ensure that it complies with its required number of certificates that it needs to purchase each year. What the utility then does is charge all the electricity consumers for they recover all the costs from the bills. So if you're an industrial customer or a commercial customer or even a residential customer in these markets, you'll have a charge on your bill which is funding their certificate purchases. If you're not participating in the scheme, you're paying for other people's energy efficiency projects, which is kind of an interesting outcome. So I won't go through all these details here, but just a couple of key points. If you look at the number of parties involved, so in Victoria, you've got 25 liable parties, so there's 25 utilities. You've got 187 accredited certificate providers. There's 31 million registered certificates to date, so that's 31 million tonnes of CO2 abatement. Not all of which has happened today because you're for creating some of that for the sort of deemed methodology simple lighting projects. It covers a range of technologies, but is only about electricity savings. If you compare that to New South Wales, you cover a much broader range of technologies, and they're generating certificates for both electricity and gas savings. There's over 30,000 product approvals. You can't claim a certificate for a lighting upgrade in Victoria or New South Wales unless that product is approved by the government. And that requires independent testing of a whole range of factors. So this is just giving you a bit of a flavour of the split of technologies that have created certificates in the New South Wales scheme. The big red bar is lighting. So this scheme, with a deemed approach, has really liberated commercial lighting projects. It's moving towards, I want to see that sort of green bar at the top. The blue and the green at the top are probably interesting as well. New appliances that go beyond your minimum energy performance standards can create certificates as well. And industrial processes are starting to generate significant volumes. Just to give you an example, we're working on an industrial project at the moment that on its own will generate maybe 200,000 certificates. So in 4 years of operation, we've generated 1 million, and we're now seeing industrial projects coming through under an IP related but slightly customised methodology that is going to create significant volumes on individual projects. This is the Victorian scheme. Once again, if you look at these sort of grey bars at the bottom here, it's dominated by 70% commercial lighting. This is just an illustration of volatility in the price. The wholesale, in this case the VEET price. So over the last calendar year, it's been as low as $17 per certificate and as high as $39. There's a lot of speculation around why that peak actually happened. Some argue that there was a particular rogue trader in the market. Others say there was a perceived shortage of supply, but it was basically driven up on a very small number of purchases by one particular retailer. That has some secondary impacts with forward contracting in the market, so we take forward contracts now on behalf of our customers to sell the certificates they're creating, and you get some really quite risky scenarios under those sort of volatile prices. And look, just to give one user example, if you take the school gymnasium, you've got 72 metal halogens replaced by 38 LEDs. project cost of 30,000, energy savings 11,000 per annum, so it's already a good payback, right, in 3 years. There was about $9,000 worth of certificates, and the ACP has taken $2,000 out of that in administration costs. So it brought the net benefit in year one to that customer to about $18,000 and a $30,000 investment. There are significant challenges in operation that the government's going to work through. You get rogue installers we see them coming through who just fabricate information, and a range of other issues that I won't go into. But the schemes work, drives enormous activity. It's locked in. The two schemes are locked in 40 million tonnes of CO2 abatement over the next 10 years. There's been several million installations, individual installations, and for each one of those, there's photos, there's evidence of the installation. It's a regulated market, but incentivises the private sector. The ETIHAD project low transaction costs tend to be taken up first in the schemes, and we're now getting to the more difficult ones. There are definitely net overall economic benefits, and there's been regulatory impact statements showing that. The schemes are broadening in both fuel and technologies. M&V capacity is really important around the industrial projects. And interestingly, the private sector has developed tools and systems for efficient delivery of paperwork, evidence of installation. So we've got a whole IT platform that goes right down to the hands of the installer. An electrician doing installation has our app in their hand to collect some of the evidence and customer signatures and things like that. And that sort of technology can be deployed in other schemes around the world. Just to tie this back to the Philippines, what's really interesting is that the compliance work for Wapiti, Victoria is completed in an office about 70 kilometres from here in Angeles, and so we have about 7 staff here in the Philippines doing a lot of work for the Victorian energy efficiency schemes. So thanks for your time.
Thank you. Our final speaker, Mr. Julio Retana, is in charge of energy audits and ESCO development at Synergy Energy Solutions, an Indonesian energy efficiency firm which recently won the CTI PFAN Asia Forum for Energy Financing Award. His background in management and engineering allows him to bridge the gap between technology and the business strategy side of things. Before joining Synergy Energy Solutions, he undertook different positions and projects related to energy efficiency, sustainable development, business strategy, covering Central America, Asia, as well as Europe. So thanks.
Thank you very much. So, good morning, everybody. My name is Julio, and I want to start by saying that I'm very honored to be here. It's been very exciting to see what's happening in the region. I'm originally from Costa Rica, and when I moved to Asia, I knew that it was an ever-growing region, and energy efficiency having a place in the clean tech arena. It's very, very exciting. So my presentation today is about telling a story about our company and the challenges that we face and how we've overcome quite a few. So a little bit about our company. We're an ESCO company, and we're a local Indonesian company. And the way that we started doing carbon audits. And we got clients coming back to us and saying, that's really good, but could you please help us save energy and this and this and this. So we ended up in energy efficiency until one of the clients came back to us and we gave them an energy audit. They said it was great. They wanted to implement it. And we asked them, okay, do you have the capital for it? And they came back, no, we don't have anything. And that's how we ended up in performance contracting. And that's how the whole story starts. So to give you a bit of a background about Indonesia, so the IEA tells us that there's 57% of potential for energy efficiency of the region. And we see how electricity prices have increased tremendously over the past few years. The government is trying to eliminate subsidies on energy prices. And in this case, electricity prices have increased roughly around 18% over the last 2 years. So companies are becoming much more concerned over their energy prices, and the market opportunity is there. However, as with everybody, there's been challenges, and those challenges are not only unique to the country, there's those that are quite unique.
We've talked about how project hosts sometimes don't understand performance contract, how they don't understand the priority to energy efficiency, and how sometimes the policy and regulation and incentives, in the case of Indonesia, is not there. But we're going to talk about today about the finance part of it, and what I'm going to concentrate on this presentation. So basically, when people say that access to finance for energy efficiency is difficult, I can tell you firsthand that it actually is very difficult. We've probably been to maybe between 10 to 15 banks, local, multinational institutions, development banks, all sorts of meetings. And there was a moment where we were sitting down with a local bank, we were setting credit lines, and one by one they were telling us, no, you don't fit here, you don't fit there, projects are too small, we don't do project finance, there's no collateral. So we're like, okay. So we went to the people that actually did understand energy efficiency and did have the credit lines for these kind of projects. And we sat down with them and they told us, yeah, the project is great, we have the money, we need to place it in Indonesia, but our minimum investment is $50 million. So for these sizes, for energy efficiency, for the sizes that we're looking at, industrial and commercial, it's a bit too big. So basically, it became for us not so much of getting the finance as a pipeline from point A to point B, from point A from the financiers to the project, but it became more as a puzzle in a way that we don't have something, but what do we have instead? So for example, there's no debt, but what can we access? There's no concessionary finance, but there might be equity. There's no incentives from, or there's no regulation in place, but what is there that we can actually look into to actually be able to run the project? And what we found out was that there was equity available, but it changes the whole perspective of the project. Once you, as most of you know, once you look into a 100% project equity, your project cash flows change, your IRR changes, and profitability changes. So your project in itself has to become much more bankable, or much even more profitable, or much more attractive for the investors. So the first thing that we did was look at the structure. How to work in Indonesia under this model, which is very, very new. So we sat down with head of Deloitte, the head of the tax from Deloitte Jakarta. We sat down in the morning and filled in a whiteboard of, we talked about licensing, we talked about taxes, we talked about protection, we talked about regulation. And together with our financial partner, we decided to set up this structure that can enable us to work in a performance contract basis under a shared savings scheme. Now, the investor, looking at the investor, it was private equity. So basically, the perceived risk of the country is higher than in other countries. The IRRs expected are obviously, and hurdle rates are much higher. So basically, we had to concentrate on projects that were very profitable in the sense that we were looking at payback periods of 2.5, 3 years. And this means that a lot of the things that in other countries are being done through performance contracting, we couldn't do it. So we had to focus on measures that were actually quite safe, measures that we could do it within the country, and things that had a very high profitability. So we worked also with suppliers that are suppliers and equipment suppliers and other consultants to actually structure things that would minimize risk. Now with the clients, there's no de-risking mechanism or any kind of incentive for clients to actually be able to proceed with these kind of projects. So even if the technology was there, and this goes back to the potential of energy efficiency, we would go into a plant, we would go into a building, and you can feel the potential. There's a lot of things to do, and it's very good. But even if those opportunities were there, and you would get 40% savings, if the client wasn't creditworthy, the client couldn't provide a bank guarantee, we just couldn't do the project. And so the client restriction became a limitation, yes, but once it was already decided that the client would go ahead, the investors felt much more secure. And now we work with utilities in one way, so I'm just going to briefly mention it. We're trying to work with PLN in setting up the first demand-side generation project, generation-side energy efficiency project. And that brings a whole set of new challenges, but it is possible. And now this is one piece of the puzzle, and as I said, it's part of how we managed to overcome some of the barriers that we found by focusing on very attractive projects, low-hanging fruit, but in order to be able to scale and to be able to do more projects, our expectation is to actually be able to access finance once these projects are running and we have the portfolio done. And this was how we won, as the presentation said at the beginning, how we won ETIHAD as a business model in the region. And this is how those $50 million that you saw, or even less, we've already seen that it is available. This is the next stage of the project. So based on our experience, our local experience, and based on our experience of the company, yes, access to finance is very difficult. I can tell you firsthand. Getting the pipeline is very difficult. But by looking at it as a puzzle and how policy regulations can support us and make things easier for everybody, it's energy efficiency performance contracting in Indonesia is possible. So right now, as I said, we're focusing on low-hanging fruits. Our investors understand energy efficiency, they understand the risks, they understand that how the savings are made, they understand the deal. And finally, the clients. We have to focus on clients that, even though they have the savings, more importantly, is that they are creditworthy. And that is one of the biggest challenges. So that is my presentation, and thank you very much.
Okay, so that concludes the 5 presentations. Just to quickly sum them up, we've heard about an energy savings and guarantee scheme and using the Vietnam cement industry as an example. We've heard about a super ESCO model in Dubai, the Bangladesh energy efficiency program, the Australia Energy Efficiency Certificate Scheme, and finally this ESCO structure in Indonesia. So we've got the region kind of pretty well geographically covered. So I'll now open the floor to any questions.
Hello, I'm Ronald from Munich Re, the large reinsurance company. So we are, I heard now from many of the talks that there is a certain risk involved in these investments in these energy efficiency projects. And I want to ask, we are in principle prepared to take some of these kind of risks if they translate to a clear technology risk. So how do you see this translating to the energy efficiency translating to a risk in the technology which is used?
I will say the risk is more of a perception rather than a real risk, because technology is proven. If you see an example, until unless you are attempting a very, very new technology, and so there is no technology risk as such, because you will find examples of that, and manufacturers who is supplying the technology or the technological provider need to come upfront and give that performance guarantee. So when you design a deal, either using financial institutions or using ESCO, the risk should be passed on to them.
I'm sorry, could you use the mic so everyone can hear?
So to follow up is, in case of default of the technology provider, of the supplier, is then the technology risk still substantial?
Yes, it is substantial, but then he need to bear that risk in the deal how it is designed. So that's a preferable. And if it doesn't come, then the other schemes, financial institutions or the industry has to bear that. But better is to pass that risk to the technology provider. From our experience, the relevance of technology risk depends very much on the type of intervention. And technology is just a component of the overall risk. It's a composite risk, right? Let's say here, when we talk about cement, it's one main risk is technology, the other one is production levels, like, so you have an absolute, you have the loan is an absolute amount of money that was based on the assumption of how much you use your facility. When you talk about solar, which you're already doing, or when you talk about LED street lights, right, the use of the technology, the amount of use, the production side is very fixed. Right? So, I think the trick would be to aggregate the risk into its different components, right? Technology is a main risk, but there are others that would also need to be addressed in order to create a viable guarantee mechanism.
I would also say that the risk of technology is normally pretty low because working with ESCO, for example, most of them will not go and try to implement a project with the newest technology that haven't yet demonstrate solidity in its use and its approach. Most ESCO would prefer to use energy-saving technology for sure, but those that will lower the risk as much as possible because they're the one guaranteeing the savings afterwards. So for them, you normally will not go and try to implement the newest technology that haven't demonstrate its strength.
Any other questions? Next question.
Alex Vlaza, Blue Sky Energy Asia. One of the big barriers, we flow equity capital to ESCO guaranteed contracts across Asia. And one of the big barriers, in the last few days, I keep on saying that 98% of ESCOs, which are SMEs, have no real sufficient access to project capital. But I would bring up another barrier. Even if they issue the performance guarantees, they don't have sufficient financial capacity to back those performance guarantees. So in your experience, in your respective markets, in Vietnam, in Indonesia, in Australia, in Dubai, how do you see these small ESCOs? Do they have access to performance bonds, for example, from insurers and other markets? How do they go around this problem of bridging that financial gap to back their performance guarantees?
No, exactly. I actually think that a performance guarantee by a small ESCO is worthless because it cannot really stand behind it. And that's why you need third parties. And that market is completely underdeveloped.
What I can say about Dubai, because the super ESCO model that we present was also implemented as a way to address this, Alex, in a way that they are bringing up the financing either through themselves or through the building owners or facility owners, which leave the ESCO to focus mainly on their knowledge of implementing energy efficiency projects and conducting M&B and reporting.
Well, from our experience, it's one of the main risks that are inherent to any guaranteed savings or shared savings. And as Poul said, it's very difficult for a small ESCO to issue an actual valid performance guarantee. So the way is how, it's mitigation of risk. Who do you put the risk to? Do you put it to the supplier? Do you put it to the credit facility? Do you put it to the investor? And in the end, that's how you would structure it.
Next question.
Yeah, it's not a question, it's a follow-on comment because that's, some of you have heard me speak before. I'm Tom Dries, and one of the things I'm really pushing hard in Indonesia is not only the energy efficiency project loan, energy savings insurance. I think it's a critical component to accelerating the implementation of energy efficiency. And it's not a new product. It was in the US 18 years ago. Chubb was pushing it specifically to the ESCO market to add credibility to the ESCO market. I think, and they ultimately pulled out of it because the market was too small. In other words, they were just marketing it to the ESCOs, and over time, ESCOs gain credibility, and it was a cost. And everybody was saying, well, we don't need this cost anymore. Credibility's there. So it was a big starting point. But in Indonesia, what's clear to me, one of the big beneficiaries originally is for the bankers and stuff, but it's for the customers, facility owners, especially in Indonesia where there's an AE knowledge void. And you've heard me say that too, just no knowledge of energy efficiency. And they're unwilling to do anything because they have any knowledge about it. So this is a confidence. It really builds confidence, creates confidence. And I know that the energy savings insurance is being pushed in South America by the Inter-American Development Bank. And I think Munich Re is involved in doing some of the financing on that, or some of the backing on it. And so it's one of the products I'm going to be producing or working on to develop in Indonesia, because I think that in conjunction with an EEP loan product, which is what we did with the Econolir contract with ADB, with Indonesia Exim Bank, which is a savings-based, having extended repayment terms and going to existing customers, not requiring any collateral beyond their existing, what they already have. I think those two can really open up the market, and clearly this is a model. This insurance, what it did for the U.S. was enabled the ESCOs to use the guaranteed savings model, which was then funded by banks and customers using their lines of credit because they knew the savings were going to be generated.
Yeah, I mean, I think you said something very important. Basically, it kind of like didn't take off because it was too small, right? These mechanisms, they don't work on a project-by-project basis, right? That just, So how do we get to aggregation? Aggregation is absolutely key word here, right? And we believe that what we have now, the policy infrastructure around nationally determined contributions, which comes from the Paris Agreement, right? But also basically other policy drivers in these countries provide us with the opportunity for kind of like an umbrella, a policy umbrella under which these things can be done at scale. That's why I introduced, it's kind of like a sector-wise approach that when, we get, the support of relevant IFIs, the government, to create an instrument that can then be used by kind of like very transformative in nature on a subsector or sector level, right? So we kind of like need to integrate the top-down approach that comes from policy with the project-level instruments. That's why, I'm not interested in project-based intervention, but if it's something that is derived from an NDC that unleashes $1 billion of investment, then we can talk about these instruments, and create an industry. So I think in Indonesia it's the same thing, what are the policy drivers in Indonesia for energy efficiency? Who are the involved entities, right? Interestingly, we come across a lot of Ministry of Finance, basically attention in relation to this, because for them it's about other things as well, like competitiveness of the economy, for example, right? But we need to think aggregation, and we need to think bigger, and we cannot think project-based intervention.
Next question.
Hi, it's Mark Lister from the Copenhagen Centre on Energy Efficiency, and I want to pick up on that point, and I apologise also to Ingo and Norman because I missed your presentations, but this question about aggregation and actually saying let's make this work at scale, I think is really important, because you mentioned, and the overlay of the whole conference, as you can see, gearing up for the post-COP21 era of implementation. So this question about how do we create those structures which actually aggregate. I mean, that is the question that people are talking about right now. That's the structures that we have to build, and the work that I'm involved with is actually very heavily involved in that. So it's a question for all of you to some extent, is like, let's do a bit of blue sky, let's think, okay, what are the developments from here that need to happen to really sort of unlock those perceptions of risk, different perceptions of different kinds of risk, operational risk, credit risk, and technology risk. What is it that you'd like to see happen? What is it that you want ADB to do? What is it that you would like the finance community together to do to really bring something that will take us past these barriers that we actually know very well and have seen for a long time at the small level? How do we actually overcome them with these bigger mechanisms? Just a bit of blue sky thinking.
Can I just pick up on that point in the previous discussion? I wonder if we're complicating things a bit around really simple solutions. So lighting, for example, all the methods in those two schemes in Australia are deemed methods, right? So there is no measurement verification, but if someone's going to save 80% of the energy consumption in their lights, or 50%, they're not going to go back and reinstall a fluoro where an LED has been installed. And in fact, the schemes require the ballast to be completely destroyed, the terminals to be cut off, so that you can't retrofit that fluorescent back in. And so what happens in that approach is savings certainty is broader, obviously, it's less tight, but the transaction cost just goes way down. And then if you're financing a lighting upgrade, for example, well, LED technologies are, it's got so many advantages, as we know. If you've got a pre-qualified list of suppliers, the technology risk is extremely low, almost insignificant. The savings in an office building are going to be highly predictable. You're really just going to deal with the credit risk of the client in a finance deal. And I think an energy performance contract under that circumstance might just complicate things. Different for HVAC, different for industrial energy efficiency and for other more complex projects, but I don't know, I'm just throwing it out there. I guess that perhaps energy performance contracting around lighting is just unnecessary.
Okay. Well, I mean, easy for you to say. I think what you have done in Australia, you say let's not make things complicated, because you have uncomplicated things already by actually having a framework. That means, and this is actually the point that I want to make, right? In developing countries, we are using a project-based approach still, right? What you have is already a product, a financial product, right, which is standardized. And that's exactly where we need to go, and that's my answer to your question, right? And it becomes very simple, An energy efficiency investment in a building then looks like a real estate investment. And financial markets are super comfortable with real estate instruments that are basically yield producing, very low risk things, right? That's where we need to get this industry, to this perception of very standardized. It's as easy as investing in real estate. You have a building, you project the rental income from that, you have fixed yields, and then you get, and that's actually, when we talk about the big picture, that's when we get the institutional money involved, which is completely absent actually from the whole low carbon economy at this point, right? Because it's a deaggregated economy, that does not have this aggregation and standardized things that they require to meet their fiduciary obligations, right, that allow them to invest in the first place. So the big vision for us is, basically financial products to fund investments in energy efficiency, but also renewables, that get institutional long-term money into this. And what is it that we need to do to achieve that? That's basically what we should be focusing on.
Just to give an example of this aggregation in India, the Super ESCO, that is the Energy Service Financials Limited, when they started the LED program, the cost was somewhere around $4.5 per LED lamp, and now it has come down to about $1 in less than 15 months because of the aggregation effect of 330 million or so lamps to be distributed. Technical specifications have become more and more stringent. So that's a way you can.
Bill Nixie from IES. I've got a question for Craig about the Victorian and New South Wales schemes, and it really stems from one of the graphs, I think, on the New South Wales creation of certificates and how that was falling in the most recent year. In these schemes where water eligible activities are defined, is there a risk that projects may be exhausted, that there may not be enough certificates created to satisfy the targets? And if that's the case, what does that mean for policymakers? Will they expand the scope of what are eligible activities, and what will that look like for these schemes which have quite a long-term target?
Sure, thanks. So the question is there a risk of a shortfall in the amount of certificates created? And under that circumstance, the price would go to the cap. And I think it's quite high. I think tax effectively it might be like $47 per tonne of certificate. And at $47 per tonne, there's a lot that can be done. The lever the government has is the quantity to be created every year. So they're not regulating, they're regulating the price cap and the quantity, and they're not sort of regulating they're regulating how much they require to be created and the price cap. So they monitor it fairly closely. At the moment, what's happened just in the last 12 months is they have brought in the certificate creation around gas, allowing people to create certificates from gas at the same time as ramping up the target. So behind this, there is obviously a whole lot of modelling around what potential there is in the market. I think the only thing I do agree, I think the commercial lighting, you're going to see a continued decline in commercial lighting retrofits. The price of LEDs has come down, the price of the certificates fluctuates. But I think there's going to be a saturation going on in commercial lighting. You see it in some of the other technology already. So LED, halogen download replacements have declined, which is the long tail. And so you can see it in the Victorian scheme. The thing that's going to supply the certificates or save the scheme going into the future is definitely going to be industrial or complex projects where commercial chillers or HVAC or industrial variable speed drive fans, waste heat to energy. They've actually allowed now as well to the creation of certificates from cogen and also embedded generation up to 5 megawatt because it's reducing primary energy supply into the system. So yeah, at the moment, I think they're probably feeling fairly comfortable. They've got enough methods, they've got enough certificate creators, the market's fairly liquid, the price is about mid-range. So I guess I don't know exactly where it's going to go, but we kind of watch that with interest and make sure we don't get caught out on forward contracts.
Okay, we have just a few minutes, 2 minutes left. Anybody else? Okay, I guess I'll throw out a question just to maximize our time. Particularly the Bangladesh example, I noted that the returns were compelling, 3-year payback for these industries. 22 takers to the program, 6 were self-funded, and 16 were seeking financing. So I guess that implies the constraint is the financing. I mean, what did you see? A company's purpose is to make profit, and any financial executive that can make a 3-year payback return should be all over that, regardless of incentive programs or what have you. If they have access to just balance sheet corporate lending to do that should be incentive enough, but we all know for various reasons it's not. So I just thought if you could elaborate a little on that, what you've seen in the Bangladesh market.
Sure. One of the reasons is that the industry feels that taking the finance they say yes, it's a project, it can be achieved, but taking finance is a very tough game. To do certain number of paperwork and several rounds of banks. And then the approach from the bank side is that several of the industries which wanted to improve their balance sheet by implementing energy efficiency, but banks outrightly said it doesn't see the future part of it. They are still on the past side. And then the approach from the bank side is also, that's I'm saying, cell need to be created in the bank side to especially deal and pricing application. It doesn't believe that they are more on the numbers of financial rather than on technical side of the energy efficiency gains.
Yeah, we did a program, as I said, the energy efficiency loan program in Indonesia with the Indonesia Exim Bank with the ADB program. And what we found was, and it might be similar, the banks just don't offer attractive financing. In fact, it's unattractive. What they'll do is in developing markets or something, for one, let's say $1 million project, you get 70-80% financing. All right, what they'll do is they'll require new collateral for that $700,000 or $700, whatever it is. Let's say it's $700,000. But more importantly, they'll take that out of the customer's existing line of credit. In other words, and customers are not really willing to invest in energy efficiency versus having that money available for their core business. It's a real barrier. And then the next thing that they do is, for that $700,000, let's say the payback is 3 years, they'll typically, the loan term will be equal to the simple payback, 3 years. So what ends up happening is the customer sees no positive cash flow for like 3 or 4 years. It's absolutely ludicrous, frankly. And so what we did, and just as an example with the Indonesia and the ADB product, was we made the loan term double the simple payback, is what we did. All right, and then we also went after existing customers, so they already had the collateral base. And when we went, we did a loan product, went to the risk committee, showed them that in fact it's counterintuitive, this product, because most bankers feel the more you lend to a customer, the higher your risk. In fact, that's not the case, because the paybacks were so good. They increased it. It was like a 2-to-1 cash flow coverage ratio. It actually significantly improved their ability to repay their existing loans. Okay, so I think part of that problem is the real unattractive financing that banks offer. In fact, and again, they view it as, customers view them as, you say, industrial customers. This is an infrastructure investment, all right? And they just say, this is a pump, this is a motor, we're not fixing it until it's broken, all right? And then the last one, of course, was the savings piece, not having confidence in the savings. I may have told you more than you want to know, but I think that is one of the big barriers, that the banking sector itself is not structured. Many of you heard me talk about that multiple times, but I think that could be part of your problem too, the banks, what they're offering in Bangladesh.
Okay, well, I heard applause from the next room over. It's 10:30, so I guess that concludes our session. Thanks very much to our experienced presenters. We heard a wide range of models from economically, geographically diverse set of countries in the region, so thank you very much.